The Tax Reduction Institute is based in Washington, D.C., actually, and Germantown is nearby, and I live in Washington, D.C. The Institute comes to California about every 4 years, and we provide a day-long program on tax strategies for business professionals. And what we're going to talk about for a few minutes this evening are tax strategies that each of you can use to keep more of the money that you make.
Yay.
And I'd like to start with this question. Has anyone in the room ever paid more to the IRS than you really wanted to?
Yes.
All right. Yes. The questions will get tougher. So we're going to do three things. One is put money in your pocket today via deductions. And during the short presentation this evening, each one of you will generate, I would say, at least $3,500 in additional business deductions that you've been overlooking and you don't need to be. So that's number one. Number two, you're also going to get some help with your record keeping. Because when it comes to our deductions, documentation is the key. So we'll always include some time-saving documentation techniques that will actually increase your compliance with the IRS and reduce the amount of time that it takes you to do that. The goal there is to literally audit, proof your deductions. That's number two. Number three, on behalf of the Institute, I want to introduce their program. It's called Tax Strategies for Business Professionals. And you notice three dates on the front. One of them is come and gone. Open the brochures to the third panel, and that gives location. Now, May 24th will be in Jacksonville, Florida. But on June 1st, that it says Thursday, June 1st, see that? At the Hilton. Then it says Union City. That's a misprint. It should say Universal City. So please cross out Union and write in Universal. All right? Universal. And this is the pre-enrollment form. After the meeting today, you're welcome to attend that if you'd like to. You'll notice the tuition at the very top of the page is $595. Also, when I do a program for your organization, I get to offer a special reduced tuition. For those of you who want to attend, you want to pre-enroll. If you have any questions on that, let's save those to the very end. Take a look at the back of the brochure. You're going to see the space for notes. You're going to want to take some notes. None of the things we talk about in any way increase your chances of being audited, right? And how many of you have recently filed your tax return? Let me see some hands on that. Well, you don't count an extension yet, no, but a few of you have, but nobody said for what year, so that's a really good sign. But if you've already filed and didn't like how much you paid, or you've still got it yet to do, you're going to love this. And so turn to your note page. I want to start with a new rule that's very important to everyone in the room. This is a new IRS rule that says in your business you cannot lose a deduction. And this is the part to write down. The new rule says we can now take, if you have more deductions than you can use, you can take those deductions back up to 2 years and actually have the IRS cut you a check against taxes you paid in any of the past 2 years. Now, why is that important to you? I'll give you a couple examples. In your business, do you make the same amount of money every year? No. Of course not. Your income can fluctuate. So if you have more deductions than you can use, you can take them back 2 years and get a refund, or you can carry those deductions forward up to 20 years against taxes you're going to pay in the next 20 years. You can never have too many deductions. And by the way, anybody in the room in business less than 3 years? Anybody? All right. Starting out in business, is it possible to have more money going out at first than coming in? Yes. Sure. You don't lose those deductions. You can take them back against taxes you paid on income you earned even before you got into business. Bottom line is, with the new rule, you can never have too many deductions. You have a 22-year window to use them. Got it? All right, next, I want to talk about your auto or your vehicle deduction. And the reason I want to look at this with you is I know you all drive vehicles. And you use them in your business, therefore you're entitled to a deduction. Well, the IRS has changed some of the rules on this deduction. If you know what the rule changes are, it can save you quite a bit of money in your taxes. And by quite a bit, I mean $3,000, $4,000, even $5,000 in tax savings per year. Secondly, one of the favorite targets for IRS audits for self-employed people is the auto deduction. And there's two reasons they teach their auditors to look at that. One, they know it can be one of the larger deductions on your Schedule C. And number two, they know many taxpayers are not properly documented. So let's handle all that for you right now. Let me have the next slide there, if you would, Marie. Sure. Not that one. Back up to the very beginning. I got ahead of myself. Okay, what we want to do next, before we get into the vehicle, I want to back up a bit. Everyone, open your brochures and take. I want to give you a quick overview. There are 11 seminar segments listed here. Take a look at segments 2 through 6 for a moment. Number 2, deducting your entertainment. Number 3, deducting your travel. 4, hiring relatives. We'll come back to that. 6 is important. The IRS has new rules on the home office deduction. With the new rules, most people in this room can qualify for a home office deduction. It's no longer the red flag it used to be. But before we get into those, go back up to seminar segment number 1. See the one on documentation? Put a star there. Put a star by seminar segment number 1. The key to your deductions is documentation. And anyone here ever have a difficult time keeping track of all your deductible expenses? Yes. It's not the highlight of my day either. And tell me if this looks like anybody know at tax time. Now I'll take the next slide. Can you relate? I can. There's a better way. And at the Institute, you actually learn a system to audit-proof your records in just 2 to 3 minutes a day. We're going to start on that right now. One other thing about your record keeping. Your accountant is an important part of your tax team, but they're just a part of the team. Who gives our accountants the numbers they work with?
The agent.
Yeah, we do. We do. And that's what this is about, helping you give your accountant bigger and better documented numbers. Right? Okay, skipping ahead to the auto now. Let's get back to it. The IRS actually gives us 2 ways to deduct our vehicles. Method number 1 is called the IRS method. That's where in 2017 the IRS said we could deduct 54 cents for each business mile that we drove. Now, the other method you want to know about is called the actual method. Write that down. It'll help you remember it. And it's called that because with that method you actually keep track of all the money you spend in your car. So you track your fuel, oil, car wash, wax repairs, maintenance, tires, insurance, license renewal, all the money you spend in your car. Now let me get an idea. How many of you normally use the mileage method for deducting your vehicle? Raise your hand for mileage. Keep them up a minute. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. How about actual? 1, 2. All right. Anybody not sure? All right. That's one of the reasons I'm here. Anybody taking both deductions? Yeah. Let's take a look at an example so you can decide which method is best for you. And let's say, as an example, you drove 10,000 business miles during the year. And that's just an example. We're just pulling that number out of the air. And you use the IRS method. All you do is multiply your business miles, 10,000 in our example, multiply it times the IRS rate, 54 cents, your deduction will be how much? Yeah, $5,400. Now that's all there is to the IRS method. And I used to say that's not a bad deduction for simply driving your car in your business. I don't say that anymore. And let me show you why. Here's my workbook. Oh, over here. We're always doing research. We went to the American Automobile Association. They do annual studies to see what it costs to operate our vehicles. This is their latest study. Jot this down in your notes. Medium-sized car, average operating cost, 78.8 cents per mile. Large car,
How much was that again?
78.8 cents per mile for a medium-sized car. That's the average operating cost. A large car, the average operating cost, 99.3 cents per mile. And if anyone drives an SUV, you want to know the average operating cost is $1.05 per mile. Now here's the point. Take a look at those numbers. No matter what size car you're driving, what do you get with the IRS method?
Screwed.
Well, we're looking more for a number, but yeah, we're getting the idea. I mean, yeah, even if you're driving a medium-sized car, 10,000 business miles, in our example here, we generated a deduction of nearly $7,900. Large car, right at $10,000, compared to $5,400 with the IRS method. So, those of you using the IRS method, do you still think that's fair?
Nope.
One of the tips for today, switch to the actual. Switch to the actual. And you can change methods at any time. It's just a matter of having the right documentation, and we're going to talk about that next. I think 3 or 4 of you said you're using the actual method. I'll have another great tip for you in a moment. You're using the best method available. But everyone, remember this. When you're talking taxes and you hear the term IRS method, who do you think that typically benefits the most?
IRS.
So let's handle the documentation. Now, we always want to keep it simple, but we want to make sure it's audit proof. So categorically, you need 2 things to qualify for the larger deduction. That is the actual method. Number 1, you're going to track your costs. Now, most of this information you have, because it includes fuel, oil changes, car wash, wax, repairs, maintenance, tires, insurance, license renewal, interest on the loan if you're financing the vehicle, lease payments if you're leasing it. Oh, you cannot include traffic tickets or parking tickets. Yeah, those aren't included in either method. But you got all the money spent in your car. Now, what is the other thing you must keep track of in order to take any deduction on a vehicle?
Mileage.
You must have a mileage log. And when I say you must, the IRS wants you to. And they have an incentive program. They think this is a great idea. Take the next slide. It's right here. We are now subject to a 75% civil fraud penalty if we take any auto deduction without a proper mileage log. And the IRS is enforcing that. So let's handle it. IRS gives us more than one way to track our miles. Now, method number 1 is called the daily method. That's where you keep track of your miles every day of the year. How many of you do it that way? All right, good for you. Now, not one of the methods is to guess at the end of the year. Anybody ever do it that way? Now we got a room full of hands going up. Here's what you need to know. IRS gives us a way that's easier than tracking every day, safer than guessing. This is method number 2. I'll take the next slide. The IRS says we can keep track of our miles 1 week per month. 1 week per month. Yes, as long as it's the same week each month, and you're in full compliance with the IRS. Now, is that easier?
Yes.
Yeah, and safer than guessing. Now, there's a similar philosophy, a little different approach. You may like this even better. The IRS also says we can keep track of miles 3 months out of the year. And the nice thing about this is you get to choose whatever 3 months you want, as long as they're 3 months in a row. Keep track of your miles, and then forget about it for the rest of the year. Is that easier? Yeah. The IRS calls that a 90-day sample. And to qualify, you can choose whatever 3 months you want, as long as they're 3 consecutive months, and as long as they are representative of your typical business activities. So what does that look like? Well, you're going to keep a good mileage log for 90 days. You're going to have your beginning odometer reading, your ending odometer reading. That'll tell you the total miles driven during that test. Let's say it was 2,000 miles. Now, during that 3-month test, the IRS wants you to keep a good log of your business activities. All that running around you do in your vehicle to do business. So, let's say you drove 2,000 total miles. You added up your business miles, and let's say they came to 1,800. Well, in this example, 1,800 out of 2,000 happens to be 9/10 or 90%. So, based on your log, the IRS says you can now deduct 90% of every dollar you spend on that car for the entire year. And you are audit proof. Yes?
For the sake of the other realtors, that's 75% of fraud?
Yeah.
75% of what?
Oh, good question. And tell me your name.
Peter.
Peter. Well, what the penalty is, if you're audited. Yeah, I know. This is important to you. You're just asking for the sake of the others. Yes, I got it. Yeah, I got it. Because you have a good log. So let's just help the other people here.
I use Marie's.
Yeah, yeah, and very good. What the penalty is this: if you don't have a mileage log, they take away the deduction to begin with, and let's say your deduction was $5,000. So they take away the $5,000 deduction, and then they assess a penalty of 75% of that $5,000 that you have to come out of pocket for. So it's pretty tough, right? So have a mileage log, even if it's just 90-day mileage log. Have a good mileage log for 90 days. So this actual method is one strategy out of 18, just on your vehicles. Some of the other things are like lease versus purchase, gift lease back, multiple cars in the family, how to convert your commute miles to business miles, so you can include some of those. Now, all these strategies will save you additional money on your taxes by increasing your vehicle deduction, but they won't help you as long as you're using the IRS method, because that's all you get is that 54 cents. And by the way, you don't get 54 cents this year. It's 53.5 cents this year. Yeah. So I encourage you to switch to the actual method, follow the recommendations for documentation, so you'll be audit proof. Yes?
If a person has been taking the IRS method for 20 years,
Yeah.
and then all of a sudden switches over to the actual method, would that be a red flag?
Very good question. Tell me your name.
Mario.
Mario?
Mario.
Excellent question. And here's the answer. There's two parts. First of all, none of the things we teach in any way increase your chances of being audited, including this. Secondly, you'll find that when you send in your tax returns are scanned by a computer, and they have a computer model that scans them to see if they're worthy of an audit. Well, that computer model cannot compare this year's deductions with last year's.
Okay.
That model has no idea what you did last year. That's good news, right? You bet. Yeah, and that's a fact. Yes, Peter.
Should your odometer verify your numbers?
Yes, absolutely. Yeah.
Peter, you can talk to me. Peter, talk to me after. I have an app called Expensify. You can take a picture of your odometer.
One more question, we'll move on.
Switching cars.
Oh, good question. And tell me your name. Jessica, we'll come back to that because that's another excellent tax saving strategy. Okay, so that's the actual method. Any questions on the actual method? You all got it? Yes. Okay, and by the way, how many of you already knew you only needed to track your miles 3 months? How many of you already knew that? That rule is not new. It's been in the tax code since 1978. So let me show you where this comes from so you feel confident to use what you're learning today. Everyone open your brochures to the inside panel. In the middle panel toward the top, you're going to see a short paragraph that will tell you a little bit more about the Institute. Far left-hand panel is a partial list of some of our national clientele. Most of those names you'll recognize. And at the very bottom, there's a paragraph. It's labeled CPE. And when you get a chance to look at that, you'll see that everything we teach has been reviewed by the National Association of State Boards of Accountancy. So you can be assured it's legitimate, accurate, and up to date. Or they would not sign off on it were it not. And that all-day program, by the way, June 1st at University City, very entertaining, not a dull, dry program on taxes. I mentioned that for a reason. We feel it's important you're entertained while you're educated. It helps you retain more that way. Is that true for any of you?
Yes.
Me too. Well, our speaker helps with the entertainment. Speaker of that program is both a CPA and tax attorney.
And a comedian.
I was going to say, does that sound entertaining? And good news, very picky about, you've probably heard of him. His name is Sanford Botkin. He's one of the top CPA tax attorneys in Washington, D.C. But two things. One, he is a hoot. He is a hoot. But he's also brilliant. He spent 5 years as legal specialist in the office of the Chief Counsel of the IRS. So it gives you an idea of the expertise. And one more thing I wanted to show you, and then we'll use this to answer Jessica's question. Next slide. You've been in programs where you've taken a lot of notes. You may miss things if you take notes like I do. We provide you with all the notes. There's a lot of reasons for that. I want you to see at least two. And this is a workbook you'll have. In this workbook are 137 tax strategies that each of you can use because they're based on money you're spending anyway. You're already spending the money, you just learn how to deduct it through your business in a way that's moral, legal, and ethical. And every strategy in here, you'll love this, is also footnoted to the IRS code, right in the workbook. So you can be sure it's legitimate, accurate, and up to date. Take this with you when you sit down with your accountant. It'll save you time and money because the research has already been done and allows your accountant to be more aggressive for you.
Can I send my accountant to take the class?
That's a good question too, and I want to answer. That's not a joke question. I get it all the time. Tell me your name. Luis. I'll come back to that. That's a really good question.
What was the question?
The question is, can I send my accountant? And that's a legitimate question. And it needs to be addressed.
I have a question. How do you memorize everyone's name in the room?
I don't. I don't. Believe me, I don't. Here's that thing I wanted to say, Peter. With every strategy, and I want you to see this, because with every strategy, we include pictures of exactly what your documentation needs to look like in case you're ever audited. Takes all the guesswork out of your documentation. Okay. Now, Jessica had the question about switching cars. How many of the rest of you have more than one car in your family? Anybody deducting more than one car in your business? Good for you. Good. Yeah, for the rest of you, you're overpaying your taxes. If you have a second car in your family, be sure and put some business miles on that car. Now, I know you're going to use one car most of the time for practical reasons. Make sure you put some business miles on that second car. Apply the actual method to each car, not the IRS method. That won't do you any good. So maybe you'll only deduct 80% of your main business car, but maybe 40% of that other car. 80 and 40 is equivalent to 120% auto deduction. You've increased your deduction, and when you spread those miles out a bit, it actually lowers the chance of an audit. So it's a win-win. And when the rules get complex, we use flowcharts. This flowchart will show you exactly how to include that second or even third car. Okay? Bring a yellow highlighter, personalize this, and then use it throughout the year to keep more of the money you make. It's not just how much you make, it's how much you keep. And this is my quiz question for the evening. There are 7 very costly words that you hear from U.S. taxpayers. And you've heard them, you may have even said them. 7 very costly words. This is a quiz question. You got nothing?
Well, you're asking us?
Yeah, that's what a quiz is, you know.
I haven't gone to school in a long time. That's what's my word.
Okay, Mario's got it. What is it?
I didn't know that was tax deductible.
Excellent. That's wrong, but thanks for playing. Give me the next slide, Marie. What does that say along the bottom?
My accountant takes care of my taxes.
That's the reason. That's a myth. That's a myth. Now, it's not a shot at your accountant. You want a good accountant. But it's a reminder, we give our accountant the numbers they work with. That's why you don't want to send your accountant. You may want to bring them. That's excellent. But don't send them because you have a role to play in this process, and this is your role. to learn what's deductible and what's not, and how to document it so you can give them the numbers that they need
I have a
to include that on your tax return. Yes.
For people like us who tend to purchase property, having so many write-offs, is there a certain amount of write-offs we can have? Because sometimes having write-offs affects buying like another property in the future. Is there like a certain amount or deduction?
You know, that's a decision the taxpayer has to make for themselves. If they're trying to qualify for a loan and they have some options on what, how many deductions they can take. Now, people that are on a salary or employees, they can't do these. They can't. They don't have a choice. They can't do it. They're the ones that pay through the nose. You're in business for yourself, you have these options.
So is there
right?
like a maximum
No.
amount that we
No.
can write off?
No.
So if I made,
There-
$50,000, can I write off $50,000?
Well, you can, remember we said if you have more deductions than you can use, you can take them back 2 years or carry them forward 20. So obviously the IRS has a provision for you to have more deductions than you can use. Write off your income and then still have some left over. Why would they have that rule if it wasn't possible?
Is it a red flag to amend your tax?
You know, that's a good question too. Boy, you guys got good ones. What's your name, sir?
I'd rather not say.
Gabriel.
You know, if you amend the tax return, is that a red flag? Is that the
It
question?
wasn't about me, right?
I got it.
So my
Oh, yeah,
friend-
to amend.
Okay, is that a red flag or will that increase your chance of audit?
Would that trigger anything?
No, the short answer is no. And if we have time, I'll come back and explain why, sort of like I did with Mario's question about changing from the IRS method to the actual. There's a reason that I can say that, but I'd have to elaborate. But the short
is
answer
your
is
name?
no.
Michael.
Michael!
You're Michael.
Yes, thank you for asking. All right, I completely forget where I was. All right, I don't.
Bear trap, you were at the bear
Yeah, you got that. You got that. So everybody's agreed that you give your accountant the numbers they work with. So let's move on from there. And with that in mind, I want to cover this last strategy, and then we'll open it up for some other questions, answer any that haven't been completely answered. Also, if you have any questions about that upcoming program on June 1st, I'll take a moment to answer those. A couple things to consider regarding that. One, whether or not you'd like to take advantage of the special reduced tuition I get to offer when I do a program for your organization. But way more important than that, ask yourself if you could use an additional $8,000 in deductions this year and every year. And that's guaranteed. All right? Okay, go back to your notes, take some notes on this, you're going to love it. You all know it's 50% deductible when you take a client to lunch. Everybody know that?
No.
50% deductible when you take a client to lunch. I want to talk about something a little bit different. I want to talk about when you have lunch with each other and you each pay your own way. What happens then? There's a special rule. And at the Institute, we call this the Dutch treat deduction. So write that down in your notes. It'll help you remember it. And it's called that because you're each paying your own way. So it applies when you're having lunch with friends, relatives, associates, but you're each paying your own way. Now, do you ever do that?
Yes.
Of course, you got to eat. So let's see how you can deduct it. So let's imagine you're at lunch with a friend or a group of friends. You're each paying your own way, and we have a little worksheet here to show you exactly how this applies to you. Yes, please, thank you. So in this example, your portion of lunch is $14. Now with the Dutch treat deduction, you have to subtract your average personal lunch. I'm using $2. I'll show you how to get to that in a moment. Once you subtract that, the excess $12 is now tax deductible. Why? Because at some point during the meal, you're going to talk about what?
Real estate.
Always comes up, doesn't it? So let's say you have lunch out a couple times a week. On the average, a couple times a week for a year, there'd be about 100 lunches. Or in this example, $1,200. At 50% deductible, that's an additional $600 deduction right off your tax return. Now here's the point. Don't we have these lunches anyway? And that's what this is all about. How money you're already spending can be deductible because of the business you're in.
Should we keep
Now,
receipts?
now you all see the value here?
Yes.
Let's document it. And let's keep it simple like we did with the car, but let's make sure it's audit proof. Let's start with receipts. What's the rule on receipts?
Keep them.
Keep them. Always a good idea to keep receipts. Also, in your notes, please write down $75. Write down $75. this is the rest of the rule. The IRS says if you spend less than $75 on your meal, you do not need a receipt to deduct it. No receipt is needed. Now you do have to you do have to document it. Here's how the IRS says you must do it. They say you must log it. Write it down. Put it on a spreadsheet. Put it on an appointment book. Put it in your smartphone, an app, but log it. You're going to log who you're with, how much you spent, and the business purpose. Now you can keep the receipt if you want to, but that's optional, but you have to log it. And the IRS says you must log it in a timely fashion. They define that as within 24 hours of the event. In other words, you're not supposed to do it on April 15th with 6 different colored pins. But the point to remember is no receipts needed, but you must log it. Yes?
What's the timeline that you need to keep these receipts or paperwork or logs?
How long you need to keep your records?
like logs.
We'll come back around to that, all right? The question is, how long do you need to keep your records, your tax records? We'll come back to that. So, step one, log it. And by the way, why is it better to log it as you go? Number one, that's the rule, but what happens if you don't?
Forget.
You forget, and it costs you money. So step one, log it. Step two is right here. To qualify for the Dutch Street deduction, you must establish your average personal lunch. And it's very easy to do. Again, using a log, make a note of how much you spend on lunch when you happen to be by yourself. For any 30 lunches during the year. Now, are there 30 lunches sometime during the year when maybe you have lunch at home?
Yes.
Or maybe you grab a snack on the run? Or do you ever get busy during the day and not have time for lunch? What would you write down for that day? Zero. Work the zeros into your average. For most people in this room, your average cost of having lunch by yourself will be less than $2. So 30 cheap personal lunches sometime during the year when you're by yourself, including the zeros. You don't have to eat by yourself 30 days in a row. That'd be boring. Just any time during the year. This is the step people don't know about it, they forget to do. Now, one word of caution here. Include this in your notes or incomplete without it. The IRS will allow us to deduct no more than 100 Dutch Street lunches per year. So there is a limit. Make sure you get that in your notes.
100?
No more than 100 Dutch Street lunches per year. However, in addition to that, we also get to deduct up to 100 Dutch Street breakfasts and up to 100 Dutch Street dinners. 300 of your personal meals are deductible if you'll do it this way. This deduction is not worth $600 to you. To most people in this room, this deduction is worth between $1,200 and $1,800 a year, year after year after year. Now, I know that's not a lot of money, but if you work for another 10 years, that's $12,000 to $18,000 in deductions on money you're spending on yourself. I don't know if you realize this, but in your business, you can literally eat your way through thousands of dollars of deductions. Now, one last point, and we're finished with this. What's the business purpose of having lunch with a friend or a relative?
Build your pipeline.
What?
Build your pipeline.
Yes.
Build a pipeline. You got to have a business purpose or you can't deduct it.
You gotta talk real estate.
All right. Here's the reason I ask. The IRS has some rules that are designed to trap taxpayers. Can you believe that? Well, I was shocked when I heard that too. And this is one of them. Because the IRS says to deduct any meal, you must have a specific business purpose. And they get to say what that means. So things like discussing business, generating business, increasing business, networking, prospect, they consider that too vague in general. But think about it. When it comes to your friends and relatives, what do you expect from them in your business?
Referrals.
Referral, referral, referral. You don't have to get creative. It's better not to. Who you're with, how much you spent, business purpose, referral. All right? That you will audit-proof those deductions. All right? And do you actually have to get a referral to qualify for the deduction? What do you think?
No.
No, it's not your fault. Your marketing efforts are a failure. All right.
Let's say you're at a family get-together at a restaurant. There's 50 of you there.
He has a big family.
You use your, we're Latin, you know. You use your credit card to pay for everybody. And then you collect their money. But, okay, is that a deduction? You're slowing down.
You know, that comes under the same category as one of the most overlooked deductions in your business. And it follows the same rules. And anybody have an idea what that overlooked deduction is?
The interest on our credit card?
No? It's an entertainment deduction, but it's a particular one.
Party, business party?
I call it an event.
A
Yeah.
celebration?
Here's a number one overlooked deduction in your business. And it's in-home entertainment. When you have friends or relatives into your home, Do you ever talk business?
Yes.
Of course you do.
Client appreciation.
And the reason they don't deduct it is because they don't know how to document it. And here, this page, these 2 pages show exactly how to document that in-home entertainment. Now, that's when you have a group over. And so the reason I bring it up, Peter, that would follow the same rules. A group in a restaurant would follow the same rules as a group in your home. So you follow those same rules.
Even
Right.
though you collect the money from them?
You're really gonna tell the IRS that, Peter?
That's the part you don't
Don't log it, don't.
Of course not. Only the amount you spend. And it's deductible at a rate of 50%. Gabriel.
What about when I buy breakfast for the escrow office? Do I get to deduct that?
50%.
You have
He does it a lot.
when I buy pastries.
At the rate of 50%. Okay.
I'm just making sure I'm not gonna get
Let me, you have a question? Did you have a question?
Yeah, after you answer his.
What?
What about if you travel out of the country? Is there anything deductible?
Can be.
Travel,
Yeah, we'll get to that.
okay.
And tell me your name?
Christina.
Christina, okay. Here's what I wanted to do. I want you to take 10 seconds of your time, and you're going to have to work with me here. I want you to turn to the person next to you. Without talking, just look at him for a moment, all right? Do it, please. Ask yourself this question. Who would you rather see get audited? We also cover the tax. Everyone take a look at seminar segment number 7. Seminar segment number 7. It says how to avoid or survive an IRS audit. Now, you've all heard of red flags, have you not?
Yep.
Yes.
Learn what they are and how to avoid them. Can anyone guarantee that you won't be audited?
No.
No. Some audits are done on a random basis. We also cover the taxpayer's bill of rights, and that's seminar segment number 7. You had a quick question?
Yes. What happens if you lost a receipt, but you get one of the cards that you on account that you use for expending, especially for business? Is it possible to use the transactions on your bank as a
Okay, that's a really good question. Is it possible? Yes. No guarantee. Now, if it's less than $75 and you log it, you're okay. If it's more than that and you need the receipt and you don't have it, if it's on your credit card statement and there's no ambiguity as to what that charge was for.
restaurant or a store, like a gift or something, but it's a business account, like a.
I got that. We got that. But it's got to you better be able to show them what you purchased and the business purpose for that purchase. All right? All right.
I wish there was
A couple of things I want to start closing with, but this is very important. First of all, how many of you are married? How many of you are married? Okay, very good. What does this mean? How many aren't sure? I asked for this, I got this. Everyone take a look at seminar segment number 4. Seminar segment number 4. You're going to say it says benefits from hiring, leasing from, and going into business with relatives. And listen to me here. If you're married, hire your spouse. If you're married, hire your spouse. Now, can your spouse work someplace else and still help you occasionally?
Yes.
Hire them. Now, they don't have to help you very much. You certainly don't have to pay them very much. But here's what happens when you hire your spouse. They're your employee now. So you include, as part of their compensation, tax-free fringe benefits. And because you're married to them, those apply to you as well. If you want to take $6,000 to $7,000 a year right off your tax return, hire your spouse.
What about children?
And that's in seminar segment number 4, and of course it's obviously in the workbook. How many of you have children that you spend money on? Okay. If you have children that you spend money on, or even grandchildren that you spend money on a regular basis, hire them. Hire them. Now, when you hire your children, the IRS says they must be at least 7 years old. That's the truth. So they do have their standards at the IRS. Secondly, listen to this. Listen. You're going to miss the point if you don't listen. When you hire those children, you're going to pay them. That creates the deduction. But do you actually have to give them the money? Nope. The answer is no. You can put the money in a custodial account. It's in their name, but you sign on the account. So what you're doing is you're making money that you're going to spend on them anyway, tax deductible. Hire those children.
Do you have to 1099 them?
No, W-2. W-2. 1099 won't do any good. All right? Hire those children. So, who's single? Who's single?
Well, can you go back and explain the marriage kit? Do we have to give them like a, how do we?
You hire.
Writing on?
No. Who's single? We don't leave
They
anybody
put
out. We got
labels on
married.
postcards,
Tell me your
Jessica.
name.
That's simple.
Brandon.
Brandon, who else raised your hand?
Oh, all you single people, raise your
Oh,
hand.
tell me your name. Andy? All right. I'll pick on YouTube, but it applies to everybody in the room that's single. You're going to love this. At that all-day program, you get 18 tax strategies that will pay for you to get married.
She doesn't want to get married.
Yeah. I think I'll leave that one out next time. And answer this question for me. Who all is thinking they might want to attend that upcoming program? Because I want to tell you about the special reduced tuition. Everyone tear off the third panel of the brochure, please. Tear off the third panel of the brochure. And if you'll step with me, this will take about 30 seconds. You'll still have your notes. This is the pre-enrollment form for that program on June 1st. Remember I said it's at Universal City. This offers you the opportunity to invest $595, guarantees you at least $8,000 in new deductions. I did say there's special reduced tuition if you'd like to pre-enroll tonight. At the very top of the page it says $595. Please draw a line through that. Cross that out. And right in just above there, $395. $395. And to take advantage of that, complete the enrollment form. You can use a credit card or a check. When you've completed the form, I only want the top part. It's very important you tear off and keep the bottom part. That's your receipt. Now, why would you keep your receipt? This is a test question.
Tax deductible.
Very good. Deductible when you're in business. Everything's cheaper when you get a deduction. All right? And I didn't point this out, and I need to. Any questions about the pre-enrollment? Very straightforward. Okay. I mentioned this earlier, but I didn't point it out. Right here on this panel here, there's a short paragraph it's marked your no-risk offer. Everyone take a look at that. And it's our written guarantee. It says you'll increase your deductions by at least $8,000. The program costs you nothing. And circle that paragraph, and then jot this number down in your brochure, $14,400. $14,400. Every year we survey our attendees. Last year, the average attendee increased their deductions by $14,400. So again, it's your money. It's ways to keep more of it in your pocket that are moral, legal, and ethical. Last thing here, real quick, and it goes to what Christina asked. Who in this room's gone on a vacation where you were able to deduct at least part of it? Anybody? All right. How would you all like to be able to deduct every trip you go on from now on? Yeah, why not? If you can do it and do it right. There's a problem. The IRS doesn't make it easy. They have over 138 pages of rules and regulations on deducting your travel. 138 pages. Well, I mentioned earlier, when the rules get complex, we like to use flowcharts to simplify them. And this is our travel flowchart. And this flowchart summarizes all 138 pages of IRS rules and regulations on deducting your travel. Now, which would be easier to use? Take your time. Oh, thank you. Yes. And vacations are not deductible. Everybody hear me? They're not. But the IRS says if you're willing to combine some business with your pleasure, you can deduct the trip. If you follow their rules, all the rules are right here. These are the rules for deducting travel out of the country, right here. These are the rules for deducting travel throughout the U.S. Always consult the flowchart before you go, not after you get back. It's a series of yes or no questions. Answer the questions. Make sure you qualify the trip before you go. Otherwise, it's too late. All right? And this page here will show you how to document it, so you audit proof it. Now, you do need to know one other thing to use this flowchart.
How do we get the book?
You need to know how the IRS defines business-related travel. And they have an unusual definition, so listen carefully. IRS says business travel is being away from home, sleeping in a strange bed while conducting business.
I did that Saturday.
I
went home after.
Yeah, that's their definition, not mine. All right. Yeah. And who all is seriously considering attending that upcoming program? Raise your hand. I want to get a count. Okay. 1, 2, 3, 4. Super. And the reason I ask that is we have a policy at the Institute. When I do a program such as this, and at the conclusion we have 3 or more pre-enroll, your tuition tonight will be $295. $295. So be sure and write $295 on your form if you want to take advantage of that. Make sure I get the enrollment form. Make sure you get a ticket from me. You'll need a ticket, and I've got those here with me tonight. Any questions before I close? Mario.
I was told a long time ago when I got in this business, I was told by someone, I won't say who, but the general gist of it was, do your taxes. Have it done by a CPA. Don't have it done by your nephew or your son-in-law or brother-in-law. Pay about whatever it is, 25 or 30% of what you make on your 1099. Have it done by a CPA. just pay it, bend over, pay it, don't worry, you'll never get out of it. Is that a rumor? In other words,
That's a rumor.
if you go and do the whole thing at home and you do the Quicken thing or whatever the hell it is, you know, that you're looking for, but if you go to a guy that charges you $700 and he goes through the whole thing, and there's lines on your little worksheet, and one of them says miscellaneous, and we don't know what miscellaneous means. I still don't know what it means. For 15 years, I don't know what miscellaneous is, but it's worked so far. My point is that, no, I'm being serious. I'm being quite honest. Is that enough to keep the IRS away 90% of the time?
You want the real answer?
I'd like the real answer.
No, that's not keeping them away. 99% of the people in this room may not be audited, but it's not because of that. Believe me, trust me.
It has nothing to do with who actually does your tax. They
Oh.
don't care whether or not it's done by a CPA, a guy, or you do it yourself.
I didn't say that.
Okay.
I thought you were talking about that safe harbor thing. Just
No.
pay 25 or
No, I'm
30%.
talking about who actually does your
Here's
tax.
where that can help.
Please.
Well, there was two parts to that question.
Yes, sir.
Okay, so first part, that will not keep you from being audited. Just because you're overpaying your taxes doesn't mean that you won't get audited. But the other part is this, where that can come in handy. It's true. When your tax return is scored by the IRS computer, if it scores high enough on the program, it gets kicked out for a possible audit. Before it's audited, some auditor actually reviews that tax return.
And they call your guy.
Nope. If they have discretion, they have more tax returns there than they're going to have time to audit. So they pick and choose. And if they happen to see a reputable, somebody a very good reputation that did your tax return, they may pass that one up. They may. They don't have to. If they see something unusual, they still. So no guarantees there.
See TurboTax?
Here's the guarantee. Here's the guarantee. There's no guarantee you won't be audited. There is none. Some audits are done on a random basis. The guarantee to protect yourself is no matter what deductions you take, you have the proper documentation. And if you're eligible for the deduction, take it and document it. That's my firm advice. All right. One more and then we're going to close.
Time frame for books and records. You never
Oh, yeah. All right, here's the answer to that. How long keep your records? For a normal audit, the IRS can go back up to 3 years. So you want to keep your records for a minimum of 3 years after you file. But I would go longer than that, and I'll tell you why. Because the next threshold is if for any reason you fail to report at least 25% of your income in any given year, like let's say you misplaced a 1099, it's an honest mistake, then they can go back up to 7 years. And if they ever prove fraud, they can go back to the first tax return you were ever required to file. So you don't ever want to get caught there. But the typical advice is keep all your tax records for at least 7 years. Keep your tax returns forever. All right? I'm gonna close, and you got good questions, but I'll be here for a few minutes. So with individual questions, I'll take them. I won't walk out the door right now, and that'll also give the ones that are gonna attend that all-day program time to complete their form and turn that in.
So $295, is that correct?
$295, yes.
Whoever wants to go $295, let's thank Michael for a really good presentation.
Thank you.
I think you guys all